Every government promises its money is safe. Every Treasury Secretary assures the system is sound. And every generation believes them. But behind the speeches and press conferences lies the most audacious financial illusion ever performed. An illusion so refined, so deeply woven into the machinery of the modern world, that almost no one questions it anymore. America doesn't just print money when it needs cash. It buys its own debt and calls it policy. This is not conspiracy. It's accounting. And it's the foundation of the entire American financial system. When most people imagine government borrowing, they think of foreign creditors, China holding U.S. debt, pension funds seeking safety, or banks storing reserves in treasuries. That's part of the story, but only part, because the deeper truth is circular and far more dangerous. Hidden inside the balance sheet of the Federal Reserve, the central bank of the United States, sits the quiet evidence of a self-financing empire. The U.S. government doesn't just borrow money. It creates the money it borrows from itself. Here's how the trick works. When Congress spends more than it collects in taxes, which is most of the time, the Treasury issues bonds. These bonds are IOUs, promises to repay borrowed money with interest in the future. In theory, investors buy them. Individuals, banks, foreign governments. They hand over real dollars in exchange for those IOUs. That's how borrowing is supposed to work. But what happens when there aren't enough investors? What happens when interest rates must rise to attract buyers, high enough to crush the economy? Or when the world simply loses appetite for U.S. debt? That's when the Federal Reserve steps in. Technically, the Fed is independent. In practice, it moves in perfect rhythm with the Treasury, two hands of the same body. The Fed doesn't need to find cash. It creates it, with keystrokes, out of thin air. And with that newly created money, it buys the government's bonds. No investors needed. No real savings required. Just digital entries in a government computer that turn debt into currency. The Treasury issues a bond, a promise to pay $1 billion plus interest. The Fed buys that bond by creating $1 billion new dollars. The Treasury spends those dollars into the economy. And the Fed holds the bond, a government promise to itself. It's like writing yourself a check and then depositing it into your own account. This happens every single day. Trillions of dollars in government securities sit on the Fed's balance sheet. Not bonds bought from investors, but bonds purchased directly or indirectly from the Treasury with money that didn't exist before. It is the most sophisticated form of money printing ever devised. And it hides in plain sight. The scale of this quiet operation is staggering. In 2008, during the financial crisis, the Fed's balance sheet exploded from under $1 trillion to over $4 trillion. During the COVID pandemic, it soared again, peaking near $9 trillion. Each jump represented the same process. The Federal Reserve creating money to buy debt, government debt, corporate debt, mortgage debt. Each time, the justification was the same, a crisis. Each time, the effect was the same. More dollars chasing the same amount of goods, services, and assets. But what began as emergency policy has become routine. When the government spends on defense, infrastructure, or social programs, it doesn't wait for tax revenue. It issues bonds, knowing the Fed will be there to buy what private investors won't. That feedback loop defines modern finance. Spending drives borrowing. Borrowing drives money creation. Money creation fuels more spending. A perfect circle until the circle breaks. The genius of this system is how normal it looks. There are rules against the Fed directly purchasing bonds from the Treasury. There are market auctions, complex operations, and official-sounding committees. It all creates the illusion of independence. But strip away the formality, and the reality is clear. One branch of government is lending money to another branch using money it invents for that purpose. No company could legally do this. No family could survive on this logic. Because it severs the most fundamental law of economics, the link between earning and spending. When a business expands, it must either save from profit or convince investors to risk capital. When a family buys a house, they must prove they can repay the loan. But when the U.S. government wants to spend more, it simply issues bonds and has them purchased with newly created dollars. The consequences ripple outward through the entire economy. When the Fed creates money to buy bonds, that money flows into the banking system. Banks use it to make loans. Loans create deposits. Deposits create more money. Each dollar created by the Fed becomes the foundation for several more circulating in the economy. That's why asset prices have soared even as wages stagnated. Why housing costs have outpaced incomes. Why stock markets can hit record highs while small businesses struggle to breathe. The new money doesn't flow evenly. It flows first to those closest to the financial center. Banks, corporations, investors. They buy assets before prices adjust. They benefit from the inflation before it reaches the street. By the time the new money filters to ordinary families, it buys less. The bond trick isn't just a bookkeeping maneuver. It's a mechanism of wealth transfer, from savers to borrowers, from workers to asset owners, from the future to the present. And most people never see it happening. Defenders of the system call it modern monetary management. They argue that economies are too complex for simple rules like spend only what you earn. They point to academic theories that justify money creation as a tool for growth, liquidity, and crisis response. But theory doesn't change the arithmetic. Every dollar created dilutes the value of every dollar already earned. And like all illusions, this one depends on belief. It only works as long as people believe the money is real. That belief, the faith that a dollar tomorrow will still be worth a dollar today, is the true collateral of the American system. And that faith is beginning to crack. When workers watch their savings lose purchasing power while billionaires grow richer, they feel it. When young families can't buy the homes their parents could, they live it. When retirees discover their pensions buy less each year, they understand it. The illusion is fraying. The bond trick doesn't stop at America's borders. It underpins the global economy. For decades, foreign governments eagerly bought U.S. treasuries. They trusted the dollar. They used it to settle trade, buy oil, and anchor their own currencies. This trust made the dollar the world's reserve currency and allowed the United States to finance endless deficits with minimal consequence. But that era is ending. China, Russia, and other nations have learned the risks of dependence. Sanctions, trade wars, and political weaponization of finance have revealed the fragility of the system. Now, they are building alternatives, digital currencies, gold reserves, regional payment networks, to escape the dollar's orbit. Not out of hostility, out of self-preservation. Because any system that allows one nation to create money at will to buy its own debt grants that nation enormous leverage over everyone forced to use that money. And the mathematics behind that leverage are unsustainable. Each bond purchased with new money adds to the debt. Each dollar created to buy those bonds reduces the value of every other dollar in circulation. As the debt grows, more bonds must be issued. As more bonds are issued, more money must be created. As more money is created, its purchasing power declines, demanding still more debt just to maintain the same level of spending. It's a spiral, accelerating with every crisis, every stimulus, every promise. During the COVID emergency, Congress authorized trillions in spending. The Treasury issued trillions in bonds. The Fed created trillions in new dollars to buy them. It happened so fast that private investors barely had a chance to participate. That's not capitalism. That's monetization, the direct funding of government spending with freshly created money. But the most dangerous consequence of all isn't financial. It's political. When money can be created at will to fund any agenda, the bond between taxation and representation begins to dissolve. Politicians can promise programs without raising taxes, knowing the central bank will quietly cover the gap. Voters can demand benefits without feeling the cost, because the cost hides in the slow erosion of purchasing power. The illusion breaks the feedback loop that keeps democracy accountable. In this system, spending is no longer tied to earning. Promises are no longer tied to resources. Reality becomes negotiable. And once that illusion is accepted, once people believe money can simply be created without limit, the decline is only a matter of time. Because the resources money represents are finite. Labor, energy, materials, trust. When governments act as if these limits don't exist, collapse follows, not all at once, but in waves of inflation, instability, and loss of confidence. Today, the U.S. stands at that edge. The magician's hands are trembling. The audience is starting to see the wires. The government writes itself checks. The Federal Reserve deposits them. And the world keeps pretending this is normal economics. But every illusion ends the same way. The lights come up. The trick is revealed. and the crowd realizes the magic was never real. The question is not if the illusion breaks, but when. And when it does, it won't just be the magician who suffers. It will be everyone who believed that the paper in their wallet was money. Because in the end, this story isn't about banking or policy. It's about belief. The bond trick is the architecture of modern faith, a faith in numbers, in authority, in the idea that the system will always hold. But history tells us otherwise. No empire has ever escaped the mathematics of debt and devaluation. No currency has ever survived infinite creation. The illusion can last years, even decades, but not forever. When belief fades, money dies. And when money dies, societies change, violently and irreversibly. The shell game that built prosperity becomes the fuse that burns it down. Because in the end, every dollar is a promise. And every broken promise has consequences.